Hi everybody. I'm aware that I am the last speaker before lunch, and I will make sure that my accounting presentation will be as short as possible. And I'm here for lunch, so if you have questions, don't be shy to come up and ask the question. And for the gentleman over there asking about the tax rollover, there is a YouTube video to talk about that capital gain tax and all these Section 85 rollover. So feel free to go to my channel. There is one just on that. A little bit. When I got invited by Ming, it was it's always an honor to be invited to speak, and because the range of the attendance here, so I decided to go back to the basic, and I'll go really quickly. A lot of the materials, I've done it many times. So if there are things that you're not sure, feel free to come up at lunchtime. I'm on social media. I just wanted to point out that I have a little YouTube channel there, youtube.com/real estate tax tips. If you guys have anything that you unsure of, I always have some sort of video topic online to walk you through that. I have a book that was ranked #1 on the real estate investing side. If you guys are interested, you can download it for free here. So it's just a free book if you are interested. Usually I need to introduce myself during this time while you guys do the scanning. I have been working in this niche. I am a real estate investor. I have been working with real estate investors since 2014. And today our firm works primarily with real estate investors, helping them structure their tax affairs, and also identifying all the filing requirements for your real estate investing as well. Little bit disclaimer, always, I'm not responsible for anything I say here. You need to talk to your own accountant that knows your particular situation. There's always some broken telephone in terms of my presentation and then your understanding of my words and then your translation to your accountant and his or her understanding. So if you don't currently work with an accountant, we're always looking for to work with you. But if you are currently working with someone that's trustworthy and reliable, make sure that you consult with that person before implementing any of the stuff that I teach here. Rental income, how is it being taxed in Canada? Well, for those of you who don't know, Canada, you are required to report rental income for the most part of it, unless you do some cost sharing arrangement, very minimal rental, then you may not need to report it. But for the most part, all rental income, if you do it as a business, you would be required to report the rental income on your tax return. Now, where you report it, it really goes back to your ownership structure and how much capital gain tax you would have to pay, or whether you would be able to deduct some losses if you have initial losses. They all depend on your initial structure. Now, if you own the property right in your personal name, then you have to report your rental income on your personal tax return. If you own the property in your corporation's name, then you will have to report the rental income on your corporation tax return. Now, in the personal side, Canada operates with a progressive tax system. What a progressive tax system means is that the more income that you earn, the more tax that you would have to pay. Now, in front of you is a chart of 2024 tax rate on the personal side in Ontario. Now, basically between $0 and the first $12,000, you pay zero tax. It is the personal tax exemption amount in Ontario. Now, in Canada, you pay tax to the federal government. You also pay tax to the Ontario government. The first tax exemption amount is $12,000. And when my mom and I had the conversation earlier, she's like, "Well, why are you? Don't you guys?" Because she also has to file her taxes here. She has a rental property here, and she asked me, "Oh, do I have to pay any taxes?" And I said, "Well, you have to pay taxes, probably because her house is free and clear." And she's like, "Well, I have personal tax exemption there, no?" I said, "Yeah, $12,000. Actually, in federal government, in the eyes of federal government, the first $15,000 they don't pay. You don't need to pay tax. So my mom was shocked to find out that the personal tax exemption is only $15,000 in Ontario, and it is a bit of a joke because you cannot live with $15,000. Let's just face it, right? They should really raise it, but they're not raising it. If anything, they're raising taxes these days, sadly. Now, so between $0 to $12,000, you don't pay any tax. Between $12,000 and $15,000, you pay roughly the first layer of federal tax, which is 5%. I think it's around 5% there. You see the marginal tax rate, 5%. That 5% is represent the Ontario tax that you have to pay. Now, between $15,000 and $51,000, you have to pay 20% tax. The way that it's being calculated is that you take your income, 51,000, the third line over there, 51,000 minus your previous tax bracket, which is 15,000. I have the formula over there, and multiply by your marginal tax rate, which is 20%. Now, for someone who makes about $150,000, essentially you have to go through every single tax bracket, take the delta and multiply by the corresponding marginal tax rate. And that's how you come up with a rough idea of how much taxes you would have to pay. Now, so what it really means is that for someone who makes $150,000 in 2024, that person roughly has to pay $42,000 of tax. Now, this is just income tax alone. If you work for someone, obviously there's further deduction. There's an EI that you have to contribute, there's CPP that you have to contribute. But if you're a self-employed individual, then you don't have EI, you have CPP. So everyone's situation is slightly different, but this gives you a general idea of how our personal tax system works. Now, let's say you make $20,000 net rental income from your property. Now, instead of the $150,000 in the previous slide, all of a sudden you got $20,000 additional rental income. That additional $20,000 net rental income is being added to your baseline, which was $42,000 before, and that additional $20,000 is being added. So that $20,000 is going to be subject to 45% tax because it's being added to your baseline of $150,000. So if your net rental income really goes back to how much, so the tax on your net rental income really goes back to how much money you report in your personal tax return, assuming that you're owning it in your personal name. Now, but what if you own the property in the corporation? Well, corporation, there are multiple types of tax situation. They tax you based on the type of income that you're getting. The first one is active business income. They tax you based on if the income that you're generating is considered active business income, you pay 12.2%. If you compare 12.2% to this chart here, it is a lot better than the personal side. Now, rental income generally are considered specified investment business income. That's what they call it, specified investment business income. Sometimes people call it passive income. This includes rental income, dividend income, interest income, for those of you who do private lending. So specified investment business income works differently. It's not a 12.2%. It's not as simple as that. It operates under a refundable dividend tax system, which means that initially you get 50% charge on tax. So that $20,000 net rental income that you pay, that you earn, you will have to pay CLA $10,000. But out of that $10,000 that you that you pay to CLA, a portion of that would be refunded when you declare a taxable dividend to your personal name. Gets complicated. Net and net, out of the $20,000 of net rental income reported in a corporation, you need to pay 20% tax inside a corporation. So essentially $2,000 after you declare the personal tax, declare the dividend out of the corporation, which I'll get into. Now, and then there's capital gain. Capital gain is also passive income, but capital gain is under a different category. The reason why it's under a different category because the full capital gain is not going to be taxable. It's only the taxable portion of it that you need to pay tax on. Now, corporation tax system, I mentioned earlier, active business income is considered 12.2%. Net rental income sometimes can be considered active business income if you have more than 5 full-time employees. employed in that business. So if you're looking at, I once had a conversation with an investor who inherited a bunch of properties from the previous generation, and those properties are all within the same corporation, and they have more than 5 full-time employees. They would be able to report the rental income as active business income. But the key here is that the only way to do it is if you employ more than 5 full-time employees. So specify investment income, like I mentioned, it includes rental income, dividend income, interest income, and all that. And they go through this system. Essentially, you need to pay 20% on the net rental income after you declare the taxable dividend, only inside the corporation. Now, but you will have to pay personal income tax on the dividend that you receive as well. So 20% is not complete picture, it's 20% plus whatever dividend tax that you will have to pay. So covering it very fast because I have 18 minutes left. Now, the good news about owning rental properties is that you also get to write off expenses and you get tax deduction. So in certain part of the world, for example, where I grew up, in Hong Kong, you basically report the net rental income. The only deduction you get is 20% on your rental income, gross rental income. So you don't get any deduction. Here in Canada, you get tax deduction. Now, why is it so important? Because you sometimes in the real estate world investing, particularly first year when you're setting up the property for rent, chances are you're going to incur a loss. And that loss would be you could potentially use that loss to offset against your other income. So tax deduction is very important. Now, what kind of tax deduction you would be able to claim? Basically, the rule is that if you incur the expenses for the purpose of generating that particular stream of income, you would be eligible to deduct the expenses, subject to a bunch of exceptions. So as long as you are able to establish the cause and effect relationship between incurring the expenses and earning that particular stream of income, you would be able to claim the expense, subject to a bunch of exceptions for sure. But just keep that in mind. When you're incurring the expense, you think, okay, I am taking my accountant out for a coffee to talk about my tax plan, that coffee bill would be tax deductible. And chances are the mileage that you drive to see your accountant would be tax deductible. Now, these are the things that only you will be the one able to keep track of the amount of expenses that you incur. Now, once you establish that cause and effect relationship, make sure you keep the receipt. No receipt, no deduction. So it's as simple as that. Nobody is going to follow you around and say, hey, this is tax deductible, so you keep the receipt. You are the one that's responsible for it. So those are the two biggest things. And bank statement and also credit card statement are not sufficient. So just because you have bank statement and you say, well, I spent all my money using my bank, that bank statement is good enough to prove that the interest or the bank charges are deductible, but it is not good enough to prove that you actually incur the expenses. So make sure that you keep the original little slip. If you don't have it, it's as simple as taking the picture and sending it to a dedicated email address. So it's all there. You only need to provide it when you get audited, if you ever get audited. So the goal is not to ever get audited because it's a very time-consuming process, not productive process. Now, some of the most common tax deduction, CMHC insurance, I heard from Ming earlier that sometimes we do CMHC insurance to purchase property, that is tax deductible. Some of the CMHC insurance or mortgage insurance are being added to the mortgage, so meaning that you're really repaying it over, 25 years. But then the CMHC insurance would actually be eligible for deduction. Even though you're paying it over 25 years, you can still deduct it, but you can deduct it over a 5-year period, not immediately. So that's pretty cool. You get a pre-deduction before you completely pay out the amount. Line of credit interest, if you borrow from one property to purchase your next property, as long as you are able to keep track and keep the proof of investment, the transfer, you would be eligible to deduct the interest expense. mortgage interest, property tax, utilities of that particular property, all deductible. Insurance, property management fees, accounting fees, repairs and maintenance, and capital cost allowance. So for those of you who are familiar with repairs and maintenance, if you renovate a property or convert a property into a legal 3 units or 4 units, and it was originally from 1 unit, then chances are that expenses would not be deductible as repairs and maintenance because you're not repairing it, you're building something brand new. So when you build something brand new, it doesn't mean that you can't deduct it. You just add the cost of your conversion to the cost of your purchase. When you eventually sell that property 10, 15 years from now, you would be adding all these costs of renovation to the cost of your purchase and all added together that form the cost basis or your purchase adjusted cost base, that's in the accounting term, to deduct against your future sale price. And with that, I also want to mention that those documents, you cannot delete it. Some people think that, oh, well, I can delete all my receipts within 7 years, but the reality is that those expenses that you're planning to deduct against your sale price, you have to keep it 7 years after the sale of your property, not after the purchase of your property. So just keep that in mind. And a lot of people don't understand when they calculate the capital gain is the renovation that they did or the AC that they purchased that they did not write off as repairs. So make sure that you keep the documentation and you are mindful of those expenses and put it in a side package, side pocket envelope. Keep it forever, essentially. Capital cost allowance, which is depreciation, you would be eligible to deduct some depreciation, but this is a tax deferral thing. I'm not going to go a lot into details because I only have 12 minutes, but yes, again, my website has a lot of the information. My YouTube channel also has a lot of these information as well. So make sure that you visit there and get more information. Now, I also wanted to mention bad debts. For those of you who are who are in this business, inevitably we at some point, hopefully never happen, but if you do have uncollected rent situation, you wanted those documentation. If you are, I have clients who have never got any proper documentation for uncollected rent, and CLA ended up just looking at the lease and say that you must have collected the money from this guy in cash. That's why you're not reporting it. But the reality is the guy has never paid, the tenant has never paid. So you need to keep copies of your text messages chasing the rent or copy of those emails asking for money, because it's not going to work if you just say that I did not receive the money. I show the bank statement to CLA, I show the bank record, but what I don't have is the communication between the tenants and the landlord to support that they didn't receive the money. So make sure that you keep those documents. Some people join, for example, events like this today to learn about real estate investing. To a certain extent, remember I mentioned that the general deductibility rule, that you incur expenses for the purpose of earning that income, you would be eligible to write off the expenses. Now, this is one of those things that membership or fees and events, well, today would be one of those events that you should be eligible to deduct the expenses because you're learning how to invest. Now, the problem though is that if you don't have a stream of income coming in, you currently don't own a rental property yet, then what do? Like, how do you deduct it? What are you deducting it against? Because at the end of the day, CLA is going to look at, like, are you generating income? You're not generating income. So it makes the argument a lot harder when you're saying I'm learning to invest to generate money, but you're not generating any money or not taking any action. Now, today's event is very, had a lot of information and is a very, from a value perspective, this is fantastic. For kudos to Ming and also Andre putting this together. But there are events out there that cost tens of thousands of dollars and coaching program that cost tens of thousands of dollars, in case you don't know, and it makes it so much harder to deduct expenses when you don't take action afterwards. Because remember, you have the cause and effect relationship. You have no ground to argue with CLA that you took actions when there is nothing to show. So just keep that in mind, how difficult it is to deduct membership and events if you don't have any action taken. Does that make sense? Okay. So automobile expenses, home office expenses, I have a detailed video, so you can always watch those. I am not going to cover them in detail. Now, net income. So essentially, when we talk about rental income, we have the gross revenue coming in. Then we have the expenses that we deduct. And then we come up with the net rental income. And that net rental income is the amount that's subject to tax. So you could get rent for $40,000 and your expenses are $41,000. Now I have a $1,000 loss, right? Or I could have $40,000 and my expenses is $38,000 and now I have a $2,000 income. And that is the amount that's going to be subject to tax, not the $40,000. It's the net amount. Now, let's say you now incur a loss, and it's not uncommon over the last couple of years because the interest rate has been so high. And so a lot of our clients are reporting losses. And that losses, in certain situations, can be used to offset against other source of income. Now, let's go back to our example here. Now, this guy who's making $150,000 from his T4, and now all of a sudden he's reporting $20,000 of income, $20,000 of loss. Now, from whatever reason, because the renovation takes longer, for whatever reason, there's $20,000 of loss, or the interest cost is high. Now, that $20,000 of loss is not a real loss. Because that $20,000, you can offset it against the income that he's reporting from his T4. So instead of $150,000 that you're reporting, now all of a sudden, this guy is able to report $130,000 of income. Yes, question?
So let's say your investment property that's losing it's in a corporation.
Yeah.
And you're making your T4 like a good job.
Yeah.
You can actually offset.
You can't. Then it is
Okay.
then there's a mismatch, right? If you own it in the personal name, then there is that benefit.
Okay, it's only when it's in your personal name.
Yes. Now, however, so here we're talking about maybe this guy would be able to get a refund for up to $8,600 because he would have, his employer would fully withhold taxes and pay it to the government on a monthly basis on that $150,000 without knowing that he would have a loss to offset. Okay? So then when he files the taxes with the $20,000 loss, he should be able to get back the money that's on the top marginal tax, the top income of 43%. So instead of losing $20,000, this guy is now losing $20,000 minus the $8,700. That's the net true after tax cost. Does that make sense? Now this is only available in personal name. Now, if your property is in the corporation, that's a great question, depending on how your corporation is structured. Now, recently last year I sold 2 properties, and the properties were all held in the corporation. And so what happened is that those 2 properties, I'm making capital gain on it. The losses, the rental loss, remember, I still run it and then I still have high interest rate. And so I have regular rental losses. My rental losses, I'm able to offset against my capital gain tax. I don't know if that makes sense. Like whatever income that you have, you would be able to offset against that capital gain tax. Now, if you are incurring losses and losses and losses and you're not selling the property, 10 years from now, the losses that you've incurred over the years, you can carry forward for 20 years. So you would still be eligible to claim it against your future capital gain. So reduce your future taxes. Okay, I think I only, according to this, it's 5 minutes, okay? I'm just clarifying. Now, what about the sale of your property? Now, for the sale of the property, many people think that, well, I'm selling a property, it should be all capital gain. Or I moved into the property before I lived there before as my primary residence, therefore it is tax-free. But the reality is not like that. Depending on the use and your intention of the property, a property sale can be treated as a flip, which is 100%, means that 100% of the profit that you make is taxable. Or if you are in it for long-term rental, long-term investment, it could be treated as capital property, in which case the profit sale from your sale would be considered capital gain. And if it is considered capital gain, 50% of the profit is taxable. But if it is considered business income, like the situation with a flip, then that 100% of the profit is taxable. Now, let's say you buy a property and you sell it and you make $100,000. If it is considered capital gain, only $50,000 you need to pay tax on. Does that make sense? And if it is considered a flip or a business income, some development, or I heard from someone who's doing subdivision of land, there could be the case that CRA may argue that it is business income. If it is business income, the profit that you make, 100% of it is subject to tax. So, and of course, we know that, I don't know if you guys know, that we're no longer going to have this capital gain inclusion rate change. Thank you for Justin Trudeau stepping down. Yes, so it's not going to happen, so that's the good news. So that's why I don't want to put a lot of emphasis on the change. I know the official announcement was that they are going to postpone it until next year. The chance of that coming back is next to nothing, so thank you. Finally, I can say thank you, Justin Trudeau. So the criteria to decide whether a transaction sale, the property sale, is considered capital gain versus income, it really just criteria. So I'm done. So essentially, you pay tax on the capital gain. I don't know if they're eating.
I don't know why they
Why is that said? We need to. We just need to eat. So thank you so much. Feel free to come down to ask me if we talk about capital gain tax. I just go through all these things after.
Hey guys, before we go off, a couple of things here. So we have two sponsors today. We want to thank for their sponsoring of today. We have Cherry, come back. We have Cherry and Cher that sponsored the coffee that you guys are enjoying. And we have Premier who's sponsored our lunch today. So we want to bring it over to our sponsors just to speak a couple of words. Maybe we'll start with Premier then.
Peter's Vlog one, this is their Premier renovation.
I'll just go with those guys.
Sorry, it's not something up.
Hey guys, the pizza's gonna get cold soon, so my name is Peter Vlog from Premier Quality Renovations. We're a company doing renovations for the industry, and I've known Andre for probably 20 years. And we do big renovations, small renovations. We have a subsection that helps people with being your own GC. So we wrote a book. I'm not sure where it is, you're Andre, but how to be your own general contractor. Remember, a GC is not a guy swinging a hammer or operating a saw. A GC is strictly the organizer of trades. All right, so it's a great book. It really, really helps you keep yourself out of trouble. It's kind of like your GPS, how to get from here to Florida, but you can get from here to your renovation destination without falling, of course. Really good product. See me afterwards, and we have a consulting business that'll consult and hold your hand along the way. Happy lunch.
Thank you, Peter. Next, Sherry, can you pour the coffee today? Maybe you want to talk a bit about Sherry?
Oh, share, yes. Right. I think I'm speaking on behalf of my husband here, and so totally unexpected.
Oh, sorry. I thought Erwin told you.
No, he sort of told me, but that's how husband and wife communicate, right? So, Share is an asset management company that helps you to acquire property, single-family homes primarily in the United States. Typically, they work with you. Title remains with you, even though it's an asset management company. They help you purchase. I don't want me to talk, but they help us, also myself, to purchase property in Texas. And generally speaking, as you know, these days somehow making money in the U.S. is better. Like in U.S. dollars is better.
than making Canadian dollars. So this is a venue for us who are, I see it as a platform and stepping stone for us to essentially purchase that property, take a step, a track, a guide, a coach, you may, to help you purchase that property. And if you want to find out more about Share, we have a link and I can share that for anyone who wants. And I'm actually hosting a webinar too, so I don't want to talk too much, so I'll let you.
Thank you. Before we break for lunch,